So the reserve deposit got deferred to December 8th. And then the 4210 F6, which is the transactions with exempt accounts involving good faith securities, also got extended. And they can grant the 42G10D is they can grant additional time. So margin requirements have essentially been extended past December 8th for November 19th's trade date or deficiency date. So if somebody was margin called not last, sorry, but on the 19th, we would not see that play out till at least December 13th at the earliest. When MSR article is going to say forget GameStop, short interest is only 113%. Can you explain in simple terms what a future role is to someone who's semi new to the market? Sure. Let me try to use like a used car. All right, so you've bought a used car and you've driven it for a while, and you've done some wear and tear to it, right? And then when you go to sell that used car, in order to get a buyer, you need to repair some of the damage, right? Like so you're willing to take some of the money out of your potential profits from selling the car to repair whatever's wrong with it, right? And so that would be or to keep the car, right? That would be rolling the futures, right? And you have to like pay off the loss in order to continue it moving forward. And then a failure to do so would mean that the car dies, right? So or that you would not be able to get as much money for the car. So either it fails against their margin, or they can't find a counterparty to pick up the contract. I think how was that? That was on the fly. It may not have been the best. But like nobody wants to buy your shitty used car without you doing some repairs to it, right? Okay. Can you explain in simple terms what a sushi roll is to someone who's semi new to the food scene? Raw fish wrapped in rice. Complicated explanation. Can we sell covered cars? I think it's beneficial for them to fail. Unless they cannot sustain the margin. Okay, so this is tricky. So when they roll those contracts, they use those contracts against their margin. So as soon as the contract is rolled and sold, then it becomes a credit, right? If they fail, then they get a debit against their margin, right? And so by getting the credit, they're able to like expand their margin for whatever this position's worth. If it's worth, 50 million or 5 billion, that's the amount of credit that they can flip that to. And so by taking that old short position and packing it into these contracts and then flipping it to a credit, it works for their margin instead of against it. But when they fail, that position becomes a debit, right? And so then they have to make up the failures to delivers within the expected time frame. But by failing, they buy themselves more time, which means they don't have to expend the capital up front. Will you post any TA during the squeeze for handicaps like me? I'm not streaming or talking to anybody once the squeeze has started. Roll into earnings and clip.